Let's dive straight into the secret playbook for hacking the financial system. Welcome to this explainer. Today, we're taking a deep dive into the wildly popular world of alternative credit builders. We're going to find out if these flashy, highly advertised fintech apps actually live up to their massive hype, or if they're just, well, another clever way to part you from your hard-earned cash.
So let's start with the big million-dollar question that probably brought you here. Can you really cheat code your way to a better credit score without drowning in massive debt? I mean, if you spent literally any time online recently, you've absolutely seen the ads. Slick interfaces, bold claims, promising to boost your score practically overnight. But what's the actual math behind the marketing? Let's peel back the curtain.
Because the stakes here, they're massive. Look at this. Recent data shows that users starting with a credit score under 600 who used apps like Kickoff saw an average jump of 86 points in just 1 year of making on-time payments. 86 points! That's not just a number. That is literally the difference between getting denied for an apartment and finally getting the keys. It's the difference between a punishing, rip-off auto loan rate and an affordable one. But how on earth are they actually doing it?
Well, that brings us to Section 1, the Credit Catch-22.
To understand the solution, we kind of have to start with the painful reality of the financial system. It's this incredibly frustrating loop that keeps young adults, immigrants, and really anyone recovering from past financial stumbles completely locked out of the game. Picture our little animated stickman trying to walk right into a bank to get a simple credit card. Wham! He's instantly blocked by this massive brick wall. Why? Because the bank looks at him and says, "Sorry, we can't give you credit because you don't have a credit history." But wait, he can't get a credit history because no one will give him credit in the first place. It is the ultimate catch-22. Historically, people were told, oh, just rely on shady payday loans or incredibly restrictive traditional secured cards to climb over this wall.
Which leads us nicely into Section 2, hacking the algorithm.
Now, what's genuinely fascinating about this next part is that to beat the game, you've got to understand the algorithm controlling the gates. Remember, the credit bureaus aren't, actual people sitting in a room judging you. They are strict mathematical models. Just look at this breakdown of the FICO algorithm. 2 factors, your payment history at 35% and your credit utilization at 30%, make up a whopping 65% of your entire FICO score. And these fintech apps we're looking at, they are engineered, almost surgically, to target exactly these 2 slices of the pie.
So the absolutely crucial thing to wrap your head around is utilization. Think of utilization like our stickman walking around carrying a heavy backpack of debt. The heavier that bag gets compared to what he can logically carry, the more the algorithm starts to panic. If you have a $1,000 credit limit and you spend $900, you are sitting at 90% utilization. The algorithm basically sees you sweating under that super heavy backpack and drops your score, assuming you're in deep financial distress. Keeping that backpack super light, ideally under 10%, is the absolute secret sauce here.
But here's the kicker. The game is evolving. Newer scoring algorithms, like the FICO 10T, are looking at something called trended data. This means they don't just take a quick snapshot of your backpack today, they look at whether it's been getting heavier or lighter over the last 24 months. They actively penalize revolvers, folks who carry balances from month to month, and they highly reward transactors, the people who use their cards but pay them off entirely.
Let's jump over to Section 3, how fintech builders work.
Let's look at the actual tools and see how these modern apps totally and legally hack these algorithmic rules to magically turn you into a transactor in the eyes of the bureaus. We are tossing right out the window the old banking myth that you need to lock up a massive cash deposit, sometimes like $500 or more, just to get a traditional secured card. These new fintech alternatives completely bypass that massive upfront hurdle by totally restructuring how the credit is funded.
Let's break down the heavy hitters. Apps like Self, they essentially give you a credit builder loan, but instead of handing you the cash, they securely lock it in a savings account. As you make your payments, which builds up your installment credit, that money eventually unlocks to fund a secured Visa card, which builds your revolving credit. Boom, 2 birds, 1 stone. Kickoff, on the other hand, gives you a low utilization trade line strictly for their own store, starting at just $5 a month. And Ava? Well, Ava skips the deposit entirely by linking directly to your bank account, reporting your existing healthy cash flow as creditworthiness. Pretty smart, right? And for those of you completely starting from scratch, there are some incredibly clever options out there like the current bill card or PerPay. They actually use the money you already have, like directly routing it from your paycheck to build your credit. And because they're using your actual liquid funds, there are zero hard inquiries on your credit report. None. Plus, they report to all three major bureaus, Experian, Equifax, and TransUnion, so you get maximum credit building impact without taking on the risk of going into debt.
Now for Section 4, Rent and Alternative Reporting.
What if I told you that our little stick man could completely sneak through the back door of the bank using the bills he's already paying every single month? Seriously, this is one of the most exciting shifts in consumer finance right now. Historically, you could pay your rent flawlessly, on time for 10 years straight, and get exactly zero credit for it. But not anymore. Platforms like Bilt, Credit Boost, and Kickoff now report your monthly rent and utility payments straight to the bureaus. This takes massive advantage of recent updates in the FICO 9 scoring model, which finally recognizes rent as a valid indicator of financial responsibility. You are literally turning your largest monthly expense into a credit-building machine.
Moving right along to Section 5, the A0 strategy.
Okay, so these apps work really well by targeting specific parts of your score. But to really supercharge them, and I mean squeeze out every single point mathematically possible, you need a highly optimized trick called the AZO method. AZO stands for all zeros except one. Now, your basic logic might tell you, hey, carrying exactly zero debt across all my cards is the perfect way to get a perfect score, right? But remember what we talked about, we are dealing with an algorithm here. And algorithmic scoring models actually penalize total zero utilization because to a computer, it just looks like inactivity. If you aren't using credit, they can't accurately score how well you manage it. And that is exactly where AZO comes in. So here is your exact step-by-step playbook. Step 1. Pay all your revolving accounts down to a strict $0 balance. Step 2, leave exactly one card with a tiny balance, optimally right between 1% and 9% of its total limit. And Step 3, listen closely, because this is where 90% of people mess up. You must make these payments before the statement closing date, not just the payment due date. The statement closing date is when the issuer actually reports your financial snapshot to the bureaus. By following this to the letter, you ensure the algorithm sees incredibly low, perfectly safe, active utilization.
Finally, let's wrap up with Section 6, the final verdict.
All right, we've broken down the structural catch-22, we've analyzed the algorithms, and we've decoded the actual cheat codes. So let's finally evaluate if these apps are genuinely worth your time and money. Here's your cheat sheet summary. The pros, they're undeniable. No hard credit checks, rapid history building, and barriers to entry that are so low almost anyone can start today. But you have got to be strategic. The cons are that these subscription fees, whether it's $5, $10, or $25 a month, they can really add up over a year. You have to monitor your monthly costs carefully so you don't end up bleeding cash just to chase a 3-digit number. Make sure the app you choose reports to all three bureaus whenever possible, otherwise, you're really only doing a third of the work.
I absolutely love this quote derived right from the data. A credit builder loan and a secured card can produce a usable FICO score within 4 to 6 months. Mixing your credit profile efficiently like this, combining installment loans with revolving credit, really proves that hacking the system is completely possible. You just have to play by their mechanical rules. You can literally transform yourself from a complete credit ghost into an approved borrower in half a year if you just stay disciplined. So, there you have it. The secret playbook is fully open. Now that you know exactly how the game is played and how these alternative credit builders function behind the scenes, I want to hear from you. Which algorithmic hack are you going to use first to build your credit score? Are you going to try out rent reporting, or are you going to implement that AZO method tonight? Drop a comment below and let me know what your very first step is going to be. Keep learning, keep optimizing, and I'll see you in the next explainer.